Persistent inflation. From October 2022, investors buoyed asset market prices, dismissing concerns about economic recovery types due to perceived ending inflation. However, inflation expectations remained entrenched, reflected in the 10-year forecast staying high into early 2023, signaling prolonged inflation well above pre-pandemic levels. Despite a decrease in CPI inflation from its June 2022 peak of 9.1% to 3% by June 2023, the slow decline in core inflation indicated a challenging path to the Federal Reserve's 2% target. Federal Reserve officials recognized this persistent inflation, attributing it to strong consumption and a robust labor market. Despite high market interest rates, U.S. housing prices largely continued to rise, contributing to increased rent, which is factored into inflation calculations. Persistent wage increases and rising international oil prices, especially with OPEC's extended production cuts, further indicated an extended period of inflation. Despite the Federal Reserve's high base rate maintained until July 2023, asset markets showed optimism since October 2022. To align markets with the Fed's cautious approach and combat persistent inflation, the Fed maintained high interest rates and refrained from providing forward guidance at the July FOMC meeting, indicating a shift to data-driven monetary policy decisions. By early August 2023, market trends shifted, recognizing the Fed's stance on persistent inflation, leading to a downturn in asset markets. The Fed consistently raised the base interest rate from March 2022, facing the dilemma of whether to further increase rates or maintain the current level. Discussions about the neutral interest rate emerged, debating whether the Fed's hikes exceeded the theoretical rate where the economy stays at its potential growth rate without inflationary or deflationary pressures. The neutral rate's exact value is uncertain, but debates centered around its potential rise, justifying the continuation or further increase of the current 5.25% target rate. By September 2023, the Federal Reserve's SEP indicated members' increasing inclination towards a higher long-term rate, suggesting a shift in the perception of the neutral rate. As the Fed's tightening tendencies strengthened, the market became nervous, leading to the end of the asset market boom as it seriously considered the Fed's stance on prolonged inflation and maintaining high target interest rates for an extended period.